Short-term cryptocurrency volatility appears chaotic on the surface, but it is actually a highly mechanical process. What looks to us like random price fluctuation is often an algorithmic financial engine actively clearing out structural inefficiencies. This chart displays a 96-hour dataset of Bitcoin liquidation heat maps. We track asset price on the vertical y-axis against time on the horizontal x-axis. Dark purple indicates a low concentration of leverage. Bright yellow indicates massive clusters of liquidation triggers. This heat map operates as a real-time structural map of market fragility. It shows us where the market is most vulnerable to forced buying and selling. This vulnerability creates what we call a liquidity magnet effect. Algorithmic traders and market makers actively drive the price toward these dense yellow clusters. They do this because large players require the deep liquidity resting in these zones. It allows them to execute massive orders without experiencing extreme price slippage. Triggering these leverage zones forces automated market orders onto the books, which in turn artificially accelerates the overall price action. Over the next 4 days of market data, we will track a complete two-way liquidity cycle to prove exactly how this mechanism executes. Predicting short-term directional price movements requires mapping and following this hidden off-book leverage. Looking at this chart starting July 23rd at midnight, the asset's price is moving horizontally in a prolonged ranging pattern. Prolonged ranging naturally builds complacency and false confidence among retail traders. Assuming the local support level will hold, those traders begin opening over-leveraged long positions. As those positions stack up, a dense, bright yellow band forms between 65,000 and 66,000. Notice how it is positioned directly below the current price action. This specific band represents a massive cluster of stop losses and forced liquidation thresholds resting just below the market surface. Through standard day-to-day trading behavior, the market has inadvertently engineered a massive magnetic liquidity target directly below its current support line. Tracking this chart forward to July 24th, we observe the sweep in motion. The price breaks support and begins a steep downward trajectory toward the 63,000 level. The critical trigger moment happens exactly when the descending price physically touches the top edge of that yellow liquidation band. This creates a mechanical cascade. The initial touch triggers margin calls, and those calls force automated market sells directly onto the order book. These forced sells instantly push the price even deeper into the band, which triggers a cascading sequence of further liquidations. Observing the resulting state of the heat map, the massive yellow band has been entirely consumed. It is wiped off the heat map, leaving an empty purple void. This violent price drop was a structural necessity to clear clustered leverage, rather than a fundamental shift in the asset's underlying valuation. Viewing the chart on July 25th, we observe the market reset following the flush. A new price equilibrium forms, ranging lower around the 64,000 level. A long flush heavily shifts participant sentiment, fear dominates, and new participants step in to short the market, fully expecting further downside. Looking back at the chart, a new structural reality emerges. Fresh, high-intensity yellow bands form prominently above the current price. This new upper band represents the vulnerable liquidation thresholds of the late shorters who just entered the market. The market pendulum has swung entirely. The mechanical layout has now primed a brand new structural target, this time to the upside. On this section of the chart for July 26th, we enter the final phase. The price begins a steady upward climb, breaking away from the 64,000 consolidation range. Recognizing the dense ask-side liquidity sitting above, market makers have a clear incentive to route the price upward and execute large buy orders against the incoming liquidations. The exact point of intersection occurs the moment the price pierces the 65,000 upper yellow band. Triggered short liquidations result in forced market buys. These automatic purchases act as rocket fuel for the price momentum, driving a mechanical short squeeze. This upward sweep neutralizes the upper liquidity pool. The band completely disappears as the price sweeps entirely through it. The 96-hour whipsaw is complete. The market has mechanically hunted and swept liquidity in both directions. Reviewing this chart's initial state gives us a direct structural comparison. Here is the peak long accumulation prior to the first crash. Comparing that to this subsequent chart state, we see the peak short accumulation prior to the upward pump. These liquidation clusters share a dual nature. First, they act as magnets, attracting price due to their deep liquidity reserves. Second, they act as fuel. Because they trigger automated market execution, they aggressively accelerate price the moment they are breached. This specific 4-day event is an expression of a universal cyclical market principle. For quantitative analysts, the takeaway is clear. Short-term cryptocurrency volatility cannot be accurately modeled by only looking at the visible order book. To truly understand market microstructure, you must map the hidden off-book architecture of trader leverage. Price does not move randomly through space. It navigates a topography defined entirely by the structural fragility of its participants.